Naturally, inflation is currently a hot topic. Warren Buffett has warned that inflation is rampant across Berkshire Hathaway's businesses, despite the Fed's assurances that the current increase in inflation is just temporary. It is important for investors to keep an eye on Michael Burry's new short on bonds. But how will it affect us? And what's the best way to handle rising inflation? Don't stress yourself over this problem, because Investing Path is here to teach you everything you need to know. In this video, we will examine some of Warren Buffett's recent annual letters to glean whatever investment guidance he may have for us during times of high inflation. But before that, please go ahead and hit the like button to help more people find our channel and enter our little community. And while you're here, why not hit the little bell to subscribe to the channel and never miss a new video about money and investments? Now besides that, let's get into it. As investors, we are always on the lookout for ways to get a return on our initial investment. To visualize the relationship between inflation and investing, imagine for a moment that you are giving up the ability to buy 100 hamburgers today in exchange for the ability to buy 150 hamburgers tomorrow. Even if your investment shows a 20% increase on paper after a few years, the effects of inflation could reduce it to zero or even a loss. Rather than increasing, your purchasing power has declined. Warren Buffett had a good idea back in 1979. A few years ago, he said, "A firm could have guaranteed its shareholders a highly successful actual investment return if its net worth per share compounded at a rate of 20% per year. Internal operating performance leading to viable investment returns will be heavily influenced by inflation and individual tax rates. This result appeared less likely before. Inflation has transformed one safe investment, like 3% savings bond, 5% passbook saving accounts, and 8% US government notes, into instruments that actually reduce rather than boost investors' purchasing power over time. For shareholders, a 20% return on capital can translate to a negative real return even if inflation is only somewhat higher than it is now. Consumer prices rose by 11% in 1979 when this occurred. A guaranteed government bond at 8% isn't worth as much as it used to be. Nevertheless, back in the day, financiers are losing out on purchasing power because of this. According to Buffett, annual profits, including ordinary income tax on dividends and capital gains tax on retained earnings, can be converted into an investor suffering index by adding the inflation rate and the owner's share of the capital outlay. If this rate of return is larger than the company's rate of return on equity, investors will see a decline in their actual capital even if they make no purchases. Investing during a time of high inflation is challenging because even if the firm does well, your real return on investment could be negative due to the annual percentage loss of purchasing power and the taxes you must pay on dividend income and capital gains. We love the analogy Buffett made in 1980. Investors and businesses alike are on a roller coaster ride as inflation accelerates to the point where their upward progress is zero. There is a natural decline in their purchasing power due to inflation. Organizations need to spend a lot of money on goods and services to survive in the modern economy. People who need this product but can't afford an increase in price will be in a bind. They can either lose money by paying more, or they can raise prices and hope that their sales volume stays the same. When interest rates rise due to inflation, it becomes more difficult for businesses to obtain financing or pay off current debt, which in turn makes life more difficult for the investor. You need to choose excellent stocks that will compound your money over time. What else can we try to resolve this issue? Thanks to Warren Buffett's analysis, we know what kinds of businesses can thrive even in times of excessive inflation. To be preferred, a company needs to be able to readily increase prices even when demand is stagnant and capacity is not yet fully utilized without suffering considerable loss of market share or unit volume. In the first place, being free to increase prices at will without any sort of penalties certainly makes sense, since the company's profitability has decreased as a result of rising costs. It makes sense to pass those increases on the consumer. You might ponder, Wow, that's extraterrestrial. No company would risk doing something like that. Nevertheless, if the company in question had a moat, buyers wouldn't simply move elsewhere to buy the cheaper goods. Take as an example the management of a small film studio. The training of all 50 of your employees in Adobe Premiere Pro, Photoshop, and After Effects undoubtedly required significant resources. Imagine that Adobe's monthly charge suddenly doubles, and you make the decision to switch to a different, cheaper service. You can probably find something for the same or less money each month. That is fantastic, but it is missing several features the team normally relies on. It will cost you an additional $200 per worker in training expenses, not to mention the downtime your business will experience while switching to the new software. Trouble with your clientele has begun to worry you. They need to get their work done quickly, and wouldn't be wise to make a change at this time. What should we do next? You'll need to give over a little more cash, but that's all. If you want to stick with Adobe, you'll have to pay more. Yet another example from the actual world. As Apple has established such a solid brand identity and ecosystem, it is only legitimate for them to continue to charge ever-increasing prices to their loyal client base. In 2012, the typical cost of an iPhone was just over $600. By the end of the calendar year, there were over 800. As of right now, it is probably even higher than that. And that doesn't even factor in all the various subscription add-ons. Whether it is Apple support, iCloud, or Apple Music, Apple has you completely trapped. During times of rising inflation, investors should look for companies with wide competitive advantages or moats so they may raise prices without losing market share. Second, it is important that the firm can absorb a rise in business volume that is substantial in terms of dollars with minimal new capital outlay. As a result, your profit margins will shrink if you are unable to increase your prices to reflect the rising cost of doing business. If you want to keep or increase your profits despite shrinking margins, you'll need to do more business. In this sense, Buffett is advising investors to seek out growing businesses with room to develop. As an example, this would be challenging for a shipyard. It is not cheap to construct a sizable ship. Not only will profits be low, but increasing the number of ships produced each year is also challenging. In contrast, if Facebook is unable to pass on the higher cost to their customers, the advertisers, the firm may always expand the number of sponsored posts and other advertisements displayed on the site. It would take a lot of money and time to build new shipyards to accommodate this. This is a quick and easy way to increase the number of ads you view when browsing Instagram from 2 to 3. Your company's second distinguishing feature is its ability to adapt to changing market conditions, which is especially important in times of high inflation, for the company's rapid expansion to make the lower profit margins irrelevant. Warren Buffett provides some extra advice for anyone seeking the best strategy to implement during an era of inflation. At a conference, Buffett was questioned about India's high inflation rates, because let's face it, trading the stock market when prices are fluctuating so wildly is no easy task. The interviewer has asked for advice from those with an interest in investment. According to Buffett, inflation is a tax on those who have faith in the currency that their government has produced, and because of this, the greatest way to protect yourself and your investments against inflation is to improve your own earning ability. If you know your own strengths and put them to good use, you won't have to pay taxes or have them taken away from you. Investing in your own professional growth is the best protection and return you can get from a currency's quick decline. If you own stock in a prosperous company, your purchasing power will remain stable regardless of what happens to the value of the currency. Warren Buffett has said that it gets harder to be a successful stock market investor when inflation rises. It is difficult and your actual return can be nothing. Therefore, it is probably better to invest in yourself and your skills to increase your income and protect your purchasing power. In a period of declining inflation, keeping your purchasing power steady is less of a challenge if you know how much your money is actually worth. In addition to being in a great position to invest, you may also be able to acquire stocks at bargain prices. Generally speaking, Warren Buffett advised investing in this way during inflationary times. Businesses that have a competitive advantage, a moat, and can raise prices without experiencing any negative consequences tend to do well during inflationary periods, even while the general populace suffers as a result. If you are an investor, we hope this sheds some light on how to continue. As for now, that's all we have for you guys today. Once again, please click the bell icon to get notified when more videos on personal finance and investments go up. If you learned something from this video, go ahead and give us a thumbs up. Thank you for watching. This is Investing Path, and we will see you again until the next video.